Good day. Welcome to another lesson on how to develop a business plan. Today's topic will be organizational details or organizational structure. And organizational structure is a very important foundation for any business. So, as an entrepreneur, you need to think about it, think carefully in terms of how and where you want your organization to be, because you need to decide upfront how you're going to structure your organization. Depending on what you're trying to achieve or what your organization is trying to achieve, you need to make sure that you put the appropriate structure in place. But the most common business structure is call it a PTY, because now in terms of the South African legislation, we no longer have the CCs, or you can't register a new CC. The old one, they are being phased out. So the most common one in terms of the organizational structure or organizational type is the PTY. A PTY is what we call a company. It can have at least one shareholder up to 50. So you can't have more than 50 shareholders. So it's a company that has got shareholders of between 1 and 50. And it's generally for profit. It's a private company that is designed to make profit. So that's a typical organizational structure that most entrepreneurs will use. And the PTY needs to register. Now, when you register PTY at CIPC, it automatically as well, they register it for tax. So it's a company that once you register it, then as well they register it for tax. And it's a company that if it makes profit, it needs to pay tax, because the way it's designed is designed to make profit. The next one that sometimes actually you don't necessarily have to register it. You can operate as a sole proprietor. A sole proprietor is when an individual, like some time back, like the doctors. Let's say I'm a doctor, then I want to practice. So what I'll do, I'll just practice under my name, to say Malosi Maheta surgeries or whatever the name that I give myself. But I don't formally incorporate a new company. So it's just me as an individual, but I'll have a trading name. And in that, all the income that I receive it comes into my personal bank account, because I didn't formally incorporate it, but I'm trading as a sole proprietor. So I will be taxed at the rate that as an individual you'll be taxed at. Remember, if you're a PTY is, if you make profit, is taxed at 27% now currently, and individuals are taxed between 18 and 42%. So if you are running a business and you are operating as a sole proprietor, depending on the level of profit that you're making. If you are making, you're not generating enough, maybe you're just achieving, let's say maybe less than 180,000 per annum, you can continue operating as a sole proprietor, because you'll be taxed at around 18%. Compared to if you registered as a company, where you're going to be taxed at 27% tax rate. So those are the difference. But if you are making anything above 500,000, then you are on a disadvantage operating as a sole proprietor, because the tax rate now, it becomes 42%. So you'll be paying tax at 42%. So that doesn't give you an advantage. But the sole proprietor is the simplicity of it. It's just simple. You just operate. You just give yourself an operating name. Then you're operating as an individual. Everything else, if there's any liabilities or somebody sues the company, they will be suing you, not the company. But if you have a PTY, because a PTY, it becomes an individual on his own. It's a person. It's a legal person. So if anything goes wrong within the company, people will not necessarily sue you as an individual. They'll sue the company, unless they can prove that you as a director or shareholder, you are negligent, then, or you perform corrupt activities, then you can be sued, or you can be, legal action can be taken against you on your personal capacity. But other than that, if anything happens within the company, somebody wants to sue the company, they'll sue the company, not you as an individual. But sometimes when you're looking for funding and all that, the funders will generally ask you to sign surety. So if you sign surety for anything, then they can sue the company and sue you as well for the company failing to perform. So you must be careful when you're looking at the organizational structure. Understand how the companies work, so that you need to know that the company is a separate legal entity altogether. They are separate from you. You are an individual. But if you are a sole proprietor, you are an individual. If they are suing the company or there was malpractice, they will be suing you as an individual. But if you are operating within a company, the legal action that is taken, it will be against the company, unless you sign personal surety or you are negligent or you committed fraud. But in the normal course of business, they will sue or they'll take action against the company. And that being said, as well, if you register a company, we call it a PTY, you need to make sure that you separate the activities of the company from your own activities. So it's ideal to open a bank account for your company, so that you make sure that the company's finances are independent from your finances. So if you are the sole shareholder director, it's better for you to pay yourself a salary from the account and use your personal account for your personal activities. So don't mix the two. You need to understand the structure. That PTY, it's a legal person that's got activities on their own. So you must separate that legal person from your personal activities. So there are two separate things. That's what you need to keep in mind. But if you are running a sole proprietor, you become one. So those are the two differences between the PTY or the company and a sole proprietor and the individual. As I said, that with the PTY, the company, the legislative requirement is that there must be at least one shareholder, but there can't be more than 50 shareholders. So large companies that are listed on the stock exchange, they are still companies, but they are public companies. So they use the term LTD at the end. So for a PTY, for a normal small company, you use PTY LTD to show that this is a private company. But for large companies, which have more than 50 shareholders, they are called limited companies. So all your ShopRite, your banks, ABSA, Standard Bank, all those large companies, your Sasol, they are called limited companies. They are LTD. They are limited companies. They are listed. That means they have shareholders of more than 50 shareholders. So they become a public company. They get listed. They need to have a board, and the board of directors are the ones who are responsible for their affairs. They appoint the CEO that side. But with the private company, it's not necessary for you to have a board of directors, but which sometimes, if you are big enough, it's advisable to have a board of directors, but it's not a legal requirement. But for a limited company, for large companies, a board of directors is one of the requirements of the JSE when you are listed. So the listed companies, they're still companies, but they're not a PTY. So you can start as a PTY, and as you grow, when you want to list your company on a stock exchange, then you convert it to a limited company. But when you're converting it, it needs to be more than 50 shareholders. Then you become a limited company. And then a limited company is even remote, it's even separated from the shareholders. The separation between the shareholder in a limited company, it's even higher than the separation of the shareholder from the private company. And as well, you need to understand that the company, they need to have directors. Directors are the people who are running the affairs of the company. So in terms of the PTY, they have a board of directors that are running the affairs of the company. In terms of the PTY, you have directors on the CIPC. When you register, they'll want the director's details. That's the person that will be running the affairs of the company. But don't get confused. The director is not always the shareholder of the company. The shareholding of the company can be different. You can be a director of the company, but not be a shareholder. So when you're looking at the company document, it doesn't mean the person who's listed there as a director is a shareholder. The shareholder can be somebody else, and a director can be. The director just means the person who's responsible for the affairs of the company. So I know there's generally that confusion that when you see the director there, you assume that that is a shareholder. There is a memorandum of incorporation that sets in terms of who are the shareholders, how many shares are issued. So when you register a company, there's a document that gets completed. It's called a memorandum of incorporation. In that memorandum of incorporation, it's like the constitution of the company that you're setting up. It can set up who's going to be the shareholders and how the shareholders vote and when the meeting of the shareholders meeting will be held and all that. So you need to know and understand what is in your memorandum of incorporation, because it's important for you to understand how the company structured, the constitution of the company. That's the constitution of the company. You need to understand how that constitution of the company works. When you're setting up the company, the director are not necessarily the shareholders, but most of the time they are. You find that the directors are the shareholders. But if you want to see the shareholders and how the shareholding works, you need to look at the memorandum of incorporation, and you need to look at the share certificates that are issued by the company to see who are the shareholders in the company. As we discussed, sometimes now we also have what they call the partnerships or the limited liability company, the Inc. They've got the Inc. at the end there. So those are the type of businesses that normally like your lawyers, your accountants will set up, because it's a partnership where there is a level of liability that will flow to the owners or to the shareholders or to the partners of that institution. So the partnership and the incorporation or the Inc. are a little bit different in the structure. To say the partners, if anything goes wrong in the partnership, they are going to be sued on their individual capacity, because they have they call it limited liability. So the partnership has got a certain liability, but most of the liability is sitting with the partners in a partnership or in an incorporated company. So you need to make sure that you understand that a partnership is a totally different structure of an organization. The liabilities will flow to the partners. It's easy, and then as compared to a company or a close corporation, even though I'm saying a close corporation have been discontinued, but there are some businesses that are still operating as the close corporation. The principle is the same in terms of the structure. They are similar to a PTY. They operate like a PTY. The last one that in terms of the corporate structure that you can decide in, it's a cooperative, which is more a developmental vehicle. In terms of a cooperative, you need to have like 5 minimum members. You can have more than that. And then you set up the cooperative as 5 members. You need to make sure that you maintain those 5 members. In the South African environment, government have a lot of incentive for cooperatives. So how a cooperative work, people with common interest, they come together to form a cooperative to work together. So the cooperative is set up to serve the members of the cooperative. They can provide services to others, but the primary objective of a cooperative is to serve the interest of the members. So once you come together, you set up a cooperative, you need to have a constitution, and in that constitution, you're going to govern in terms of the activities that you can do, how many members, who's supposed to contribute how much. You need to set up the constitution for the cooperative, and you define the activities that the cooperative can do in the cooperative. And the difference between the cooperative and maybe the companies or the sole proprietor is that the cooperative is a democratic institution. So with the company, you can have a director or shareholders, they vote in terms of the shareholders, the memorandum of incorporation, which could be different, and the main objective is to generate profit. But with the cooperative, it's a democratic institution. So when you're coming in, each member of the cooperative, they have the same rights. There's no one who's higher. You can appoint a board with the chairperson who are running the affairs of the cooperative. But when it comes to the voting, one member has got one vote. So it's more a democratic setup. And in South Africa, we have challenges with the cooperatives because they fail because of how they're structured. As I said, they are democratic in nature. Sometimes you come together, it's 5 people. You know, when there are many people, sometimes certain people, they might have their differences. But because it's a democratic institution, everyone has a right to vote, and one individual can cause the cooperative to fail. So it is important that when you're setting up a cooperative, you must be sure that the members that you are setting up the cooperative with, you have the same interest, you have the same goal. And another mistake that we generally make in South Africa when you're setting up cooperatives is we set up cooperatives for people to work in the cooperative, which is not the objective of the legislation in cooperative. The legislation, the spirit of that legislation is for people who have common interests. Let's say you have chicken farmers in the area. So you might farm your chickens individually, but to access the market, you need to come together so that you have more chickens to sell. And that's how the concept of the cooperative is supposed to work. You're supposed to have, let's say, like 5 chicken farmers coming together to form a cooperative so that they can approach the market as one. And let's say they want training, they can approach a training institution as one so that they have a voice together rather than operating as individuals. And if they want to raise funding, they raise funding as one, but while they're operating their individual activities. That is the perfect structure, or the most successful structure, where individual cooperative members, they run their own businesses or their own interests, they have their own operations. They come together in a cooperative to work together, maybe to access the market, to access funding and all that. But they don't work in the cooperative. But the way we structure in the cooperative and the way we implementing them, they fail because people want to work in the cooperative. So you find the government fund the cooperative, they put money in this cooperative, and everyone joins in to work in there. So the fights happen, and then because it's the democratic institution, then the members struggle to manage each other. But if you set up a cooperative, each individual have their own operations, and you just come together to pursue your common goal. It might be to sell, it might be to raise funding, it might be to access certain things. But you come together as a cooperative to access certain benefits or to achieve certain activities. So that's a cooperative, how the cooperative is different from the other setup or the other structures of an organization. So when you're setting up an organization, just be careful. Make sure that you understand the objectives, the structure that you want to put in place, where you want to go, the strategy, so that you set up the appropriate structure. Because without the appropriate structure, your business might fail. You might set up a cooperative only to find out that the structure that you're supposed to have set up might be a PTY. A PTY might have worked better for your organization. That was the lesson on the structure or the type of organizations that you can set up. Make sure that you are deliberate in deciding which structure you are going with. Be sure which structure will provide you with benefits. And now we're going to go into the case study movies that we use to give you more practical guidance on these topics. So enjoy this movie and do the exercise that is provided at the end of the video. I thank you.
Organizational details. This is where you provide details of your organization, including all compliance registration, including but not limited to company registration information, banking information, operation and locations, key contact details.
Mr. Clark created an operating company and a property company as two separate legal entities. If your operations are too diverse, it may be prudent to create separate companies. However, it must be strategical, operationally important, and efficient to have separate registered organizations.
AY was an INC, meaning incorporated. In South African context, it is a PTY Ltd. Since AY was tendering or relying on the government for business, legislative restrictions and compliance are critical, i.e., it needs to make sure that its tax affairs are in order and has valid tax clearance.
It is not clear if the Oakland A's was an NPO or for-profit organization. Generally, sports and cultural organizations are NPO because their objective is to advance certain interests. Complete the assignment. Compare how the topic is addressed in the three movies and rank them according to your preference on how the characters and the organizations dealt with the topic and motivate your ranking, 1 being the best and 3 the worst. Analyze this topic and its applicability to your situation and industry. Write up your analysis to meet the requirement of the industry you're operating in. Update the relevant section in your business plan.